every state has adopted this actually benefit. It's called the Military Spouse Relief Act. And what that means is, as you know, I'm a military spouse. If my husband PCS is to Texas, well, let's make another one, to Pennsylvania, right? And I have to leave my job here and I move with my husband. And now I find unemployment in Pennsylvania. So if you make income in Pennsylvania, you need to pay taxes on that state, right? We're talking about states. So the military spouse relief act comes in place to protect me because I'm only there temporary. I'm not there because I chose to. I'm not there to actually make that my home. I'm only there for 3 or 4 years. So the military spouse relief act exempts you from those state taxes from the time that I'm actually there with my husband supporting his career. Now, not too many military spouses, they understand what this means. And what this means is that if I earn income in Pennsylvania, I'm exempt with that actually law, and I am supposed to report that income to the state where I am resident of. Now, you have to qualify for this. You can't just actually decide to it. And one of the qualifications, the main qualifications, is that you have to be the same state of residency of your husband. So let me give a quick example, right? So if my husband would have been a resident of Georgia and I met him, but I'm a resident of Alabama, now I would not qualify of that because we are not from the same state residency. We have to be carrying the same state of residency to be able to be exempt from the state taxes. Now, this takes in 2 different places. Once we could fill out a form, for example, here in Georgia, it's called the G54 form, I believe, if I'm not trying to remember exactly the form. You fill out that form, you submit it with your employer, and they will automatically stop withholding state taxes from you. And if you haven't done that, then at the end of the year, when you file your taxes, you should definitely be communicating that to your tax preparer and ask them if they could exempt you for it. And how do we do that is we have to actually look at the law of that state. And there's a different form, or there's a way that we could actually subtract her income. So if they did withhold any taxes, I'm assuming that I was here in Pennsylvania. I was in Pennsylvania. I worked. I made $45,000. In Pennsylvania, withhold from me $1,500 and withholding taxes. At the end of the year, when I file my taxes, they actually exempt me for it, and those $1,500, the state of Pennsylvania refunds it back to me. So that's one way. The other way is actually do it proactive, right? We fill out the form that they want, and they do not withhold any state taxes at all. Why you should do it proactive? Because if you go to a tax preparer and they have to file 2 different states, they might charge you for every state that they actually have to file.
Talking about money is an intimate affair. I mean, people are scared to talk about money. It is something that I think in our community that it's like, you don't talk about how much money you make. Taboo. It's very taboo. And unfortunately, we have to undo that by saying, we're not here to broadcast your finances. We're here to help you grow.
Welcome back to Doral Homes Real Estate Talks, the podcast where we dive into the depth of real estate knowledge and expertise. I'm your host, Betty Gonzalez. And as always, people come for the information and they stay for the community. Today, we don't have one, but we have 2 guests joining us today. So today is our 8th episode. Thank you for being here with us. In this episode, we're incredibly honored to welcome Regina Garcia, a distinguished tax consultant and bookkeeper with a unique and viral specialty. Regina isn't just an expert in her field, she's also a dedicated military spouse who has channeled her expertise into helping those in the military community. Her focus on assisting military families with short-term rentals and scaling their ventures to 6-figure successes through high-quality accounting is not just impressive, it's transformative. Regina's work empowers our military community, providing them with the financial acumen and support essential for thriving in the real estate arena. Whether you are part of the military community or simply interested in understanding the intricacies world of the real estate finances, Regina's insights are invaluable, from tax nuances in short-term rentals to strategic financial planning for robust real estate portfolios. She brings a wealth of knowledge to the table.
Hi, good morning. Thank you for having me. I'm so excited to be here and be able to share a little bit of knowledge for our military family and our community. I really appreciate you for inviting me.
Thank you, Regina. And guys, listen up. Together, Regina and Allyssia offers a comprehensive look into the world of tax and accounting, especially as it pertains to real estate and the unique challenges faced by military family. So let's dive in and explore the wealth of insight that they have to share with us today. Welcome, guys, and good morning.
Good morning. Thank you.
Good morning.
Happy to be here.
Could you tell us a little bit about yourself, your background, first, where you're from, how do you come into the world of the real estate and helping small businesses? And then we're gonna go to Regina and you can tell us how you became into the world of real estate, where are you from, how long have you been in the business? Tell us.
Okay, hi. Thank you, Betty. As she said, my name's Allyssia. So I started my business in 2020 officially. And I transitioned from being a federal auditor, working with a lot of small businesses, and just really seeing the need in the outside community of where things were lacking, where small businesses weren't as informed on when to make certain moves within their entrepreneurial journey. So it was really just saying, a lot of it's just compliance. A lot of it's just, what people say you have to file your taxes, you have to do certain things because out of the fear really of, the penalties and stuff that can happen if you don't. But it was really more saying, instead of coming from a standpoint of just focusing on compliance, it was more saying, okay, we're going to try to take this job that you've created, this business, to grow to something more meaningful outside of I'm just doing what I need to survive. And that's really something that I saw that was a need in the small business world, where it was saying, I'm not sure when I have to start making different decisions and start seeking additional help. So when I came and started my business, it was really just from a standpoint of saying, it's more about educating throughout your journey and not just saying I'm a one-time face that you see during tax time. You hand me some paperwork and then we call it a day. It's really about having that shared journey, saying like it's a partnership and that we're in it together. My business grows when I'm helping other people grow. So that's important, but it's also important that you're communicating the different aspects of your business throughout the year so that you can make timely decisions and not just waiting for year-end tax time to understand and avoid some of the things. It's more about taking a proactive approach to everything versus the reactive of taxes and
Yeah, we all wait until the last minute. I mean, this is so in time because we're right here finishing the year. And, people don't even think about the taxes. Right now, they're thinking about the holidays. And then when it comes January 15, it's like, oh my God. And then nothing happens until like April 14th.
Right.
Well, thank you, Allyssia. I really appreciate you coming on. And Regina, what about you? Like, tell me where you're from. How do you come into the world of real estate? And how long have you been doing this with taxes?
So, as you know, my name is Regina Garcia. I'm actually from Puerto Rico. We are a Puerto Rican family that my husband enjoyed the military 15 years ago. I am still an active duty military spouse. So when my husband actually enjoyed the military, I decided to go to school and I went for paralegal. Within being in the paralegal, I had to do volunteer hours at the JAG office. If anybody knows what the JAG office is, the Department of Law within the military. Once I actually was doing volunteer hours, one of the attorneys had the tax center, had to run the tax center. So he asked me to enjoy him. And I said, absolutely not. I hate numbers. I won't be able to do that. No. So he's like, come on, I know you will be great. Just, take the exam. I took the exam. I did pretty well. And I made it through my first tax season and I completely fall in love with it. One of the things that I have always been clear of what I wanted to do in life is I wanted to make sure I'm sitting behind a desk. Right? Let's just put an example. Behind the desk, I wanted to be able to be that person that people could come in with a problem and I'd be able to assist them in how to fix the problem. I never in the world thought that taxes will allow me to do that. And it's amazingly how it actually allows me to do that, especially within the military family. there's a lot of militaries that actually young soldiers that come into the military that do not know or never have filed taxes before, and they don't know what the consequences of that being meant. So I started being into the tax business about 8 to 9 years ago. And within that, as you know, every military, they PCS every 3 to 4 years. So what normally a military soldier does is purchase a home. And when they purchase a home, but then they have to actually move again for years. So they put that home for rental. And I became very knowledgeable on how to handle taxes for a rental property. And that's how I came into the real estate. I started going into the property management. And then within that, which is, it makes me so proud, a lot of military spouses like you or soldiers, when they get out of the military, they actually follow their real estate career. So since I am already have knowledge on the military taxes, they actually come to me to be able to help them with their taxes within the real estate taxes. So that's how I actually became into an expertise with military taxes, property management, and real estate.
Wow, this is so deep. I am so happy that you guys came on today because this is so needed in our military, I don't know, podcasting or to put it out there. And Regina, I have questions that I gathered for you because I'm not an expert in taxes. I know about real estate, but even within real estate, it's so much depth into it. And in small businesses, as Allyssia was alluding to, the first question that I have is, can you give us an overview of the tax and bookkeeping services that you provide, particularly for those in the military community? Like, what's the difference or how do they merge together?
So military taxes, the biggest difference between a civilian family and a military family when we're doing our taxes is the state of residency. That is what takes the most in place with it. Federal is federal applies to everyone, but the state of residency is actually what comes in place to it. So a lot of people do not really know the difference between a home of record versus state of residency. And a home of record is when you actually join the military and you oath and you say, I'm going to join the military. That home of record hardly ever changes. Only changes maybe in 2 occasions. Either you enlisted as an officer or you actually re-enlisted, and there's a different situation where you could change your home of record. But state of residency, you could change that as many times as you want. There is a form that you actually have to fill out and submit it into the finance department to be able to change your state of residency. And a lot of people do not understand this. For example, I'm going to put it in Puerto Rico. Puerto Rico does not have federal taxes. So if you oath and you join into the military in Puerto Rico, your state of residency and your home of record will be Puerto Rico. But now you pass basic training, you actually have your first station duty, and they are not withholding any federal taxes. Tax season comes in and you have to file taxes. Well, guess what? The federal says, like, we didn't withhold any federal taxes. We don't have anything. So you get hit with a big amount of money that you have to pay on federal taxes. So the Army understood that this was happening, so they actually file a memorandum to the IRS that any soldiers that actually oath for military in Puerto Rico, that I actually still claim in Puerto Rico as a state of residency, they will be exempt from federal taxes. Now, I get clients every year with the same situation. If you are new in the military and you come in to join and you're state of residency and you go to HR Black has no knowledge sometimes in this area because they're not up to date with the law of the military. So normally these soldiers have to pay thousands of dollars. Then they come to me and I have to amend it with attaching the memorandum that was given by the US Army to protect them. So we will subtract the actual income and we exempt them from federal taxes.
Well, Regina, oh my God, you are giving so much value, but you have put so much out that I need to unpack some of this because I know right now, the person that's listening to us, that's tuning in to this podcast, even if it's after the recording, it could be a spouse, it could be a brand new soldier, like you said, or it could be a brand new lieutenant that just coming into the military. Let's go back and simplify, because you went really, really, really fast about the home of record and the state of residency. So I know you mentioned once you join the service, you can only switch it like once or twice, and that's if you change ranks, usually from enlisted to officer.
Yeah.
Now, let's say this slowly so that
Mhm.
people really understand and what is the importance of them knowing these differences and when they can change it and what do they need to know to decide if they need to make that decision. Like, okay, this is my chance to change it. Should I change it? Why should I change it? I don't want to change it.
Right. So yes, so you could only change your home of record twice, maybe within the military. That is normally not changed at all. The state of residency is where you actually live more than 30 days in that state, and you're allowed to change that. Now, within the military, you have to fill out a form 2558 and submit it into the finance department. That will actually, finances will change that state of residency when in your LES or your W-2. Once that's done, you become a state of residency of that state. Why should you want to change the state of residency from Puerto Rico? Because in Puerto Rico, there's no federal taxes, but there's also no child tax credit. There's only if you have three more children, you could file federal taxes and be able to benefit from the child tax credit. And the taxes in Puerto Rico, the state, are way higher. So if you are living in the United States and you are actually PCS on it, it will be more beneficial to you to actually file taxes federal, because once you have children, if you do have children, then you are actually able to benefit yourself from the actually child tax credit. And although there's additional child tax credit as well this year, unfortunately we don't have it. But those are tax credits that you could benefit versus not getting any credits from Puerto Rico. Now, this is a decision that they have to actually make. It's a very individual decision, and you should really explore both options, right? If you're never going back to Puerto Rico and you don't want your money to actually go into this education, property taxes, or anything that way, you should think about changing your state of residency, because now maybe you own a home here in Georgia, in Florida, or in Texas, and you wanted your money to actually go make a difference of it, versus in Puerto Rico that you're not planning to go back. So that's the two difference of home of record residency and why you should change your state of residency.
Oh, wow. Thank you so much. I myself didn't know this. So I am pretty sure a lot of people out there did not know this that actually need it, because they either from Puerto Rico, as we know, we have a big community of Puerto Ricans in the United States, branches, you know, in the Army, Navy, you name it. And if they don't know this, they might be leaving a lot of money on the table.
Yes, ma'am.
Okay, thank you so much. Now, could you touch a little bit on when you talked that you could change your home of records, because home of records and state of residency are two different things.
Yes.
Why would the home of record would you be able to speak on the home of record when you change it, and why is that a big deal?
I could definitely touch bases on the home of record. So the home of record is like where you oath, and if you ever decide to leave the army will move all your household goods back to your home of record. And that's what is important, to make sure you have the home of record where you decide to retire or you are no longer in the military, because that only will pay for your household goods to be shipped to the home of record where you are. And that only takes place when you actually are separating from the military. PCS is a whole different story.
Okay, thank you so much. Allyssia, I have a question. In your field, does this matter as well? Does it make a difference or not?
In terms of for accounting,
small businesses or accounting, like, does that play into, you know, if your home of record, state of residencies, you paying taxes or not paying taxes, does that matter if you're a business owner, or it doesn't matter?
So for the home of record, it's more the decisions that are made and where the money's been allocated for within the military. So it's going to be, so I'm originally from San Antonio, Texas. So I joined the military straight out of high school years ago. And then when I got out, I moved to Ohio as my home of record. So that's going to be, you know, like Regina said, where they're going to be sending all your household goods and setting all that up. Now, when it comes to the tax time effects, your home of record's not going to be affected for tax time. However, your state of residency does. So your state of residency is going to be where you're filing. It's normally where you live, where you reside, and it's going to be affecting the taxes. And then if you have properties in additional states, that you don't reside in, you are also required in certain states to file taxes in those states as well if you're earning income in them. So especially like she said with military, if they're renting a home outside of their state of residency, or then that's something they're going to have to consider, that they might be filing multi-state returns and not just where they live. So, but the home of record does not make an impact in those areas.
Got you. Okay, thank you so much, Allyssia. Now, Regina, back to you. I have this, I spoke to you yesterday when we were talking on the phone about this law that benefits the military spouses that very few people know about, including myself. So would you be able to speak about that law that passed that protects the military spouses and how it impacts them financially or in terms of tax obligations?
Of course. There's definitely there's actually a law that was passed by the senators, right? And every state adopted. Not most of state. I'm sorry. Every state has adopted this actually benefits called the Military Spouse Relief Act. And what that means is, as you know, I'm a military spouse. If my husband PCS is to Texas, well, let's make another one to Pennsylvania, right? And I have to leave my job here and I move with my husband, and now I find unemployment in Pennsylvania. So if you make income in Pennsylvania, you need to pay taxes on that state, right? We're talking about states. So the Military Spouse Relief Act comes in place to protect me because I'm only there temporary. I'm not there because I chose to. I'm not there to actually make that my home. I'm only there for 3 or 4 years. So the Military Spouse Relief Act exempts you from those state taxes from the time that I'm actually there with my husband supporting his career. Now, not too many military spouses, they understand what this means. And what this means is that if I earn income in Pennsylvania, I'm exempt with that actually law, and I am supposed to report that income to the state where I am resident of. Now, you have to qualify for this. You can't just actually decide to it. And one of the qualifications, the main qualifications, is that you have to be the same state of residency of your husband. So let me give a quick example, right? So if my husband would have been a resident of Georgia and I met him, but I'm a resident of Alabama, now I would not qualify of that because we are not from the same state residency. We have to be carrying the same state of residency to be able to be exempt from the state taxes. Now, this takes in 2 different places. Once we could fill out a form, for example, here in Georgia, it's called the G54 form, I believe, if I'm not trying to remember exactly the form. You fill out that form, you submit it with your employer, and they will automatically stop withholding state taxes from you. And if you haven't done that, then at the end of the year, when you file your taxes, you should definitely be communicating that to your tax preparer and ask them if they could exempt you for it. And how do we do that is we have to actually look at the law of that state. And there's a different form, or there's a way that we could actually subtract her income. So if they did withhold any taxes, I'm assuming that I was here in Pennsylvania. I was in Pennsylvania. I worked. I made $45,000. In Pennsylvania, withhold from me $1,500 and withholding taxes. At the end of the year, when I file my taxes, they actually exempt me for it, and those $1,500, the state of Pennsylvania refunds it back to me. So that's one way. The other way is actually do it proactive, right? We fill out the form that they want, and they do not withhold any state taxes at all. Why you should do it proactive? Because if you go to a tax preparer and they have to file 2 different states, they might charge you for every state that they actually have to file. So if you do this proactive, then they don't withhold any state taxes, then you don't have to file taxes for that state, and you probably be saving yourself a little bit of money, and you keep that money in your pocket. So my highest suggestion is to actually be proactive, right?
Right. No, of course. I mean, not only you take taxes on your, how do you call, on filing on different states, because different states have different laws, but also throughout the year, you can use your money for whenever you need it.
Right.
I mean, and then sometimes we get so caught up on the last minute things that the last thing we have is the right forms, or even the right tax preparer like yourself. you're familiar with this, but if they go with anybody else that is not, they're not going to be like, hey, by the way, you're a military spouse. You need to fill out this form so that you can be exempted and get your money back.
Right.
That's not going to happen. One, because most people are not familiar with the military processes. And two, because the military spouses don't divulge I'm a military spouse.
And this is one of the things that definitely takes in place, because once I get, every year I grow more with be able to service my military family, right? 95% of my clientele, they're military, including the business owners of business. And the reason is because when they come to me for that year, then I actually educate them and prepare them for next year. And this is one of the things that I actually will do for the military spouses. Like, this is the form you have to fill out, submit it to UHR, and then you'll be exempt for next year. If I can't do it for this year, next year, you won't have to pay me for an extra state because you're already proactive.
This is so good, Regina. Allyssia, Regina, if after this, we need to get together, because maybe by the end of the year or the beginning of 2024, we could probably put a class together virtually where you can educate, and then you can bring this, and I can gather military groups and announce it and probably run some ads to it so that people can come and get educated, because this is really, really good. Like, I wouldn't know this because just go ahead.
In fact, I have a quick example, right? Yesterday I was speaking to a military spouse that is really stationed in Hawaii. They are a resident of Georgia. And she went to her HR, and I said, go to your HR, let her know that you guys are military spouse and that you are exempt from Hawaii taxes. And HR had no idea what she was talking about, right? Because she has a civilian job. And I said, okay, so let me actually look for the form. I find the form, I submitted the instructions, and I gave it to her for her to be exempt from the state taxes from Hawaii. And unfortunately, not too many people are actually educated, even your HR department or your tax preparer. So I would definitely suggest for you go to somebody who actually is a little bit more specialized in the military taxes, because there is a huge difference between civilian and military. And you could be leaving a lot of money on the table by not reaching out to somebody who's specialized within that field.
Definitely. No, thank you so much, Regina. I am so happy we're doing the podcast today, because it is so helpful for my viewers and my listeners. Now, I want to switch it back to Allyssia, and I want to ask her, like, the balancing the military and the financial, side of it. So as a military veteran, how has your background influenced your approach to accounting and tax services for businesses, Allyssia?
I think it's more so in the understanding that there's a larger balancing act when it comes to being in the military, because you're kind of exposed to so much more just outside of normal life. So the same thing, like Regina said, when you're doing PCS moves and when you're changing states, all these affect not just yourself, but also your spouse. And the effects when it comes to, if you do have any rental properties, any investments, anything like that, being aware of the tax implications of that move and making good decisions like the state of residency to ensure that you're reducing that tax time bill. So you don't want to take hits during tax time because you're not familiar with the structure of how everything changed because of that move. And just really understanding, also being aware of, being in the military is a balancing act. Betty, it's, there's a lot of stuff that you're forced to do. So understanding that the stuff that you're doing on the side also has a bit of a more urgency to make sure that you're keeping up with it in a timely manner. So because you don't know at what point you're going to be taken away or having something surprise come up that says you're not going to have, the time that you planned to have, say for doing your bookkeeping or saying for managing your tax time, might end up not being time that's available anymore because it got taken from you because of a move or a deployment or something that came up. So just being aware that, it's really important to make sure that you're communicating this and being on top of it throughout the year so that at the end of the year, there's no surprises and no delays, because even though you're in the military, delaying for too long will also have its penalties and restrictions on what you can and cannot do. So there are some things that you can waive because of your military activity, but there's some things that they're not going to forgive. So making sure that you're always being proactive in these decisions is going to benefit you in the long run. It's also going to protect your marriage. If you don't want to surprise deployment and your wife having to come back and look up a receipt of boxes or having to dig through stuff she's not familiar with, if it's not something that's a shared thing. So it's definitely something you want to do ahead of time. So just being aware of that.
Yeah, no, thank you so much, Allyssia. But let me ask you this, because I know what you do, but I want our audience, I don't think I did a very good job of exactly what you do. So I want them to know the field that you're in. So you are more into property management, right?
Yep. So I work with a lot of investors in property management. And that's also saying, when you're renting, when you have a property, you are that property manager. You are that, you have that property that you're having to maintain. And it's still considered passive income for you. So, even though you're doing it on the side, it's still something that you're doing. As someone, I got into real estate because I did real estate. So, I have, understanding the implications of having that rental and understanding the juggle, even though you're not full time in that short-term property, you're not working it every day, it's still income to you, and understanding the types of deductions that you can take because of having that property, and I think a lot of that's, people are unaware. I always tell people, if it's part of your business and you're saying it's part of your business, like the only reason you're doing it is because you have a property, it's better to, make note of it and talk to your tax preparer versus saying, I don't think this is allowed, and just making that assumption, because those are the times where it's like, it was allowed. And if you've been doing it for years, those are missed deductions, which means you're paying more in taxes because you're claiming it as income. You're not able to reduce that income associated with those expenses. But yeah, just being aware of all of that and understanding, like in the military, all these moves all the time. You move to a new place and they say, I want to buy a house here too. I want to buy, you go to the next day, I want to buy a house here too. And then what happens, the most common thing that I see is that they're not filing taxes in all those states. That's the number one problem that I see with moves in the military. And in real estate in general, is that when they dive into investing, thinking it's just a property, but they're not filing taxes in each of the associated states. And even if you're in your state of residency is a tax collecting state, being aware that other states might charge less. So having that additional state tax return would actually benefit you in some cases. But if you don't know, those are things that you could be missing out on. So definitely communicating that and not just saying
this is a reminder
that that's something
to go to school,
to put on the back burner. My Alexa's going off.
No, this is so good. And this could be for you or Regina. So what is the difference between short-term rental investing and long-term rental? Is there a difference?
Definitely. And actually that comes into place for the military as well, right? Because the short-term, well, Allyssia, I might let you do that because I'm thinking sell. I'm thinking the sale of a home when it comes to the military, when it's a short-term sale versus a long-term sale. Like, there is actually, you have to live in the home for 2 years to be able to actually rent it. That's one of them. And then if you're going to sell, you could be excluded the profit of the sale of the home if you live 24 months in the home, but you have to live in the home 24 months.
Well, Regina, no, I want you to touch bases on what you just said, because I'm confused. Okay. You said 2 years and 24 months, and then you said excluded and included and all this. Could you just break it down like step by step? What do you mean by this? Because this is important.
Yes, and I'm going to need your help in here, Allyssia, because it is a little bit complicated and it's a little tricky of it. So I'm talking about the sale of a home, right? There is actually an exclusion out there that it was approved by the IRS, that if I sell a home and I make a profit, and this, I like to give examples, right? Because I think examples gives you a little bit more understanding of it. If I make a profit on the sale of the home for $50,000, can I be excluded? I'm not paying taxes on those $50,000. Yes, you can. If you lived in the home for 2 years, you have to live inside the home for 2 years. Now, the military, You don't have to live in a home for 2 years in a consecutive manner, because what happens is you might be able to PCS. So if I bought a home, I live here for a year, I had to PCS and I left to Germany, and I came back and I lived in my home in another 2 years, and now I want to sell it and I made a profit of $100,000. Do I pay taxes on those $100,000? No, you don't, because you are excluded because you lived in that home for 2 years. Now, if you bought the house, and I just actually happened to happen that case not too long ago, that I had to amend this tax for this lieutenant, actually captain now, that he's in Germany. He bought the home, he lived there for 6 months, PCS to Germany, never came back, sold the home, and unfortunately he made a profit of $100,000, but he was not able to be excluded on the taxes because he only lived there for 6 months. But he owned the home for almost 7 years.
So even if he was he was not protected, even because he had to PCS, he was not protected because he did not physically live there for 2 years.
Yeah, the protection that the Army, for the military, is that you don't have to live the 2 years within consecutive 2 years. You could be spread it out of it.
So that's the difference, because for anybody, even not in the military, if you want to be, for example, in the state of Florida, if you're a single person, you can have a maximum of profit without taxable $250. And for a spouse, a couple, is up to $500 if you live 2 years.
Yes.
Now, the difference between a regular civilian person and a military spouse is that you don't need to have the 2 years consecutively.
Correct.
But it still have to be 2 years that you have lived in. You lived a year now, you PCS, you come back, you live another year. Now you have lived 2 years, not consecutively, but the only exception is that it's still 2 years, but not consecutive 2 years.
Mm-hmm. And there's a lot more to it. Honestly, we will be here all day because I love to talk about this. We'll be here all day. But there's also, if the spouse stay home and live there for several months, that could be countable as well if you're doing a marriage only.
Okay, excellent. Thank you so much. So that is for a short-term sale versus a long-term sale. Now, what I wanted to touch base was, before this came to light, was what is the difference between a short-term rental versus a long-term rental in terms of investing. You know, as we said, most of the military people, not everybody, military members that kind of like realize all of the benefits that the VA loan offered to them, then they see this opportunity and they decide that they want to use their benefits to purchase properties to then later rent, which is not a lot of us, unfortunately. So that is what I want to touch bases, and maybe Allyssia can touch a little bit more about this, because as an agent, a lot of military or personnel approach me and say, hey, Betty, I just want to buy a property that then later I can turn into an Airbnb. Or some people are more inclined to be, I don't want to buy an investment home, but I want to rent it for long term. And maybe when I come back, I just move back into my property. So what is the difference between the short term and the long term? Is there any in terms of accounting and if you run it as a business or no? Sorry, it's a long question, but I hope you got me.
You're good. So short-term rentals are going to be, in your cases, like you stated, of Airbnbs, which means that they're not staying there long-term. So they're normally short periods of time, less than 14 days, sometimes, a month here, a month there, but it's not consistent income. So obviously with long-term rentals, you're going to be hitting, people are in there for, minimum normally a year and extended time frame. So in those cases, when we're talking about like short-term and long-term rentals, the effects of just having the asset on your books are really the depreciation are equally the same on both of them. However, in terms of short-term rental, it's really about starting to monitor your level of activity in your business. So like I have long-term rental. So when you say, I don't ever go to my property, very rare do they call me, unless they say, hey, something's wrong with the plumbing, then I say, oh, I'll call a plumber. And that's about the extent of it. It's like a phone call, the plumber goes, they fix it, I pay the bill, And that's about it. That's really what you're looking at when it comes to long-term rentals. And here we're just saying, this is a property that you've had, this is a property that you're keeping, and you're trying to get a tenant in there for that consistent income. Now, that being said, that's more of a passive role. So my role in my long-term rentals is going to be, it's passive. I'm not actively involved. I might if my tenant leaves, then I'll look for another tenant, maybe put an ad, but I'm not active as in a job. It is not a lot of effort. It is very, very small. Now, when you start talking about short-term rentals, that's really where you start scaling and you start saying, my involvement in this business is a little bit more heavy in activity, meaning if you're listing it on Airbnb, Airbnb is going to help you kind of advertise. However, the part that the automatic aspect of it is not, you still get somebody in there, but you still have to, who are your cleaners? Who are you calling when there's problems? How often are they, reaching out? Are you checking up on your property more frequently? Because obviously someone's in and out. It's, if it's a vacation home, say in Florida, which is super common, you go in, you're saying, I want to check the status of my property a little bit more frequently because people like having parties here and I need to make sure, that things are right. But that starts increasing. And that's the things you have to start to be aware of. It's really tracking the level of activity because there are benefits to when you're a full real estate professional for tax purposes in that business. And the tax implications begin to say, this is going to be considered instead of passive income, it's going to be considered something that's a bit more active. So it's going to start being its own business as a whole. So you're going to start paying like self-employment taxes and stuff on it as well. So it is taxed differently, and just being aware of those changes. A lot of times, especially with people who DIY their books, they end up putting everything as passive income because they're just not aware that they can be classified as a real estate professional because of the level of activity they have with these short-term rentals. So you can even say a lot of times, you'll have your full-time job, but then you have like your full-time business because you're like, man, I'm getting calls all the time. My Airbnb is this and that. I have to restock. I have to order supplies. I'm doing Amazon and Walmart runs and, doing all this stuff, getting the cleaners, hiring new people, advertising, taking photos. All this stuff is stuff that starts adding up. That's a bit more frequent when it comes to those short-term rentals. So the tax expenses and the deductions that you're able to take are going to be different as well. And the level of detail is going to start making a difference no matter what in real estate and with real estate. And I think one of these things that we kind of didn't touch on, but it's just saying that your level of detail is not the same as just a regular business. You have to start tracking expenses by business. By property. You got to think each property is a separate business, and you have to make sure how much money have I put into this property, meaning repairs, maintenance. You can't just have a bulk category with a single bank account and just say, hey, I don't really know, was that this property or that property? I can't remember. I kind of just made a phone call. You can't do that. And really where that's going to affect is going to be when you sell your property. So if you're making any changes, if you're making any upgrades, if you're doing any of that, that's going to affect your basis for when you sell. So you want to make sure that you're capturing those costs because you want to have a true picture of how much each property is making so that you know what your loss is if you decide to sell that short-term or long-term rental. But stuff like that, just being aware of. And like I said, when it comes to real estate, that's really where you're looking at. You're thinking more property-based actions for investors, for property managers, for just real estate in general. And then it is going to be slightly different if you're a real estate agent, so you're not having those properties. So it's going to be different for that aspect of a real estate professional. But when it comes to properties themselves, it's really looking at a home-to-home basis because on your return, your homes are actually listed separately and they should be listed separately. There's only, I just had this conversation, I think yesterday, with a property manager and investor. And it's really saying on your return, you should have these properties listed separately as if they're small profit and loss statements. So they're just like miniature tax statements, but they look like small profit and loss statements. They're saying, how much income did that home generate? How much, what are the expenses associated with that home that are direct? And then if you have any type of combined property line, the only time that should ever happen is when you own something like a mobile home park. Mm-hmm. Where it's a lot of small ones. So sometimes you're able to just bulk it up as a whole just because of how that property area is ran. But when it's coming to individual single family homes or even condos and stuff like that, they should be listed separately on your tax return as Schedule E's. So you should be able to see those costs. But when it comes to your bookkeeping, it comes to your accounting, those are things you're going to want to provide at year end to your tax professional because they're going to need it. And in the end, it's going to help you because you're going to know which property is making more money than the other. You don't want to you can't just divide it equally based off of income because you might be losing money on a property and it's really going to give you that idea saying it's time to sell. Like, I'm not making money here. It's not as effective as I thought. So yeah, seeing the big picture sometimes is not helpful when it's the little pictures that are going to help you make those decisions to make that big picture grow. So really just understanding that the level of detail is a little bit more tedious, but it's worth
And don't
it.
forget, we also have to take in place the depreciation of the home as well. That is actually a big chunk of a tax break that you could add to your rentals over the depreciation.
You guys are so good at what you do, and you dive so you go so deep into this that is so many questions that come up after this. Is like, I know. So what you were talking, okay, so let me try to reframe and simplify for our listeners. So you said that each property is like individual little businesses. Some people even want to have a little LLC to each one of them. Sometimes they do that. I don't know if it's recommended, but some people do this. And what you said is if you have like a trailer property area, that's considered to be one instead of individual trailer mobile homes. And P&L, profit and loss statements. You said each one needs to have a profit and loss statements. I know that you know what this is. I understand what this is. But could you simplify in layman's terms to our audience what is profit and loss statements or P&L?
Yep. Okay, so when it comes to tax time, for sole proprietors or LLCs, meaning you're operating either just under your own name and you don't have an established business, or you do have an established business, but it's a single member LLC. And that's really who I'm speaking on just right now, because those are the returns that you file a separate schedule on your personal tax return, meaning that sole proprietors and schedule. Yeah.
Okay. Okay. You already went deep. So you said single proprietors, what is that to our
sole proprietor is just me. I'm just working for myself. I don't have a business. Right. It's just me, and so that's what sole proprietors. It means you're just working and everything goes under your name.
You can still have an LLC.
You can. Yep. So sole proprietors when you don't have an LLC. So I'm not speaking on, sole proprietors when you just work for yourself, meaning I have properties, but they're under my personal name. They're not under any LLC, meaning the liability, if something happens, that comes to me. Like, I take the hit because I did not establish that limited liability that a LLC establishes. That's what a sole proprietor is. It's just me. Now, that being said, it's super common for people, who just do little side hustles. They don't really start a business. They're just doing some little bit income here and there. They're normally operating as a sole proprietor. That being said, with real estate, it happens as well with real estate. People just have a bunch of properties under their own name and they never really establish the LLC. That's really common as well. Now, that being said, it is very common to also establish them individually as separate LLCs. And you can actually do that under a big LLC. So you mean like the top LLC is where you're managing all of them, and then you can have little LLCs underneath them, but they're just basically the properties. Now, that being said, regardless of how you're doing it, when you're doing your accounting, when you're doing your bookkeeping, you want to make sure that it's not just, vendor name, date, and the, what is it? Say advertising and marketing. It's going to be vendor name, the date of the transaction, advertising and marketing, and obviously the amount, but also what project were you doing it for? What property was that advertising and marketing? Were you doing it for, ABC Lane in Texas, or were you doing it for, Windy Street in Florida? We need to know, because that's what's going to flow. And ultimately, when you file taxes, say you're filing in a state with a higher tax, you want to make sure you're taking every single deduction for that property that you can. Yeah, exactly. So, but if you're paying, say in another state that has like a lower tax.
Alabama is.
Move it.
Yeah, so
Yeah.
exactly. So you want to make sure you're capturing only the cost there, and not, because those expenses are going to benefit that state, but you do have to file and make sure that you're claiming that in each of those individual states, like I said. But that's really when I said about limited liability, like sole proprietors, limited liability companies, LLCs, simple LLCs, which means it's just one member. If you're just the sole owner of your business, then it's all flowing to your personal tax return. You don't file 2 tax returns, it's one. Now, that being said, if you have a partnership, if you have your LLC, if you convert it to an S corporation, or if you have a C corporation, any of those, you're filing 2 separate tax returns. You're filing your business tax return and a personal tax return. But if you're just a sole proprietor, meaning work for yourself, or a single member LLC, then you're filing only 1 tax return, and it's with just additional schedules to show your business portion. Now, like I said, either way.
We get this every year. We get new clients every year where they come in with 3 or 4 properties, and in the previous tax return, everything was dumped in one whole schedule. And then we become into a problem in there because, again, I'm going to touch the basis of depreciation. This happened to me again. When a tax preparer does a tax return and it does a depreciation and does it all in one, and does not give you all the documents, and you want to decide to move on to another person, then it makes we're going to charge you extra because it definitely takes more time to actually go figure out the depreciation and separate all those properties and put them each one in a Schedule E where they need to go along with the depreciation of it. So this is very important for property owners to understand this part, because when they do hire a tax preparer, you might not know the law, but at least you know the basis of what your tax return needs to have. And each property rental needs to have their own Schedule E with their own depreciation, with their own schedules and worksheets. That way, if you ever need to move forward, or unfortunately, we get this all the time. I think this year we got a lot of them that the tax preparer that they've been using, or the accountant that they've been using for years, it passed away. And they had no way to get any of those documents. Now, we are happy to help you. However, that takes way longer to actually do because we have to go and explore all the documents that was probably done. Because in a Schedule E or in a depreciation, you could put in $45,000. You depreciate and you carry in and you're taking a deduction of $45,000. But you don't know which one is for which house because the value of each home is completely different. So being able to figure that out, it needs to be that we have to start the depreciation from the beginning when you first purchase that home. And that means that I'm going to request a lot of more documents from you, and I'm going to do a lot of more time on it, and it spends a lot of more money. So my biggest advice is to all property owners, whether it's short or actually long-term property, understand what forms do they need for tax season. Even if you don't know what the tax law, but at least you know that each property needs to have a Schedule E.
Thank you so much.
A lot of money and a lot of time.
You guys, oh my goodness, you guys are so good. This is so good. I have like 1,000 more questions, but this is what I believe. I believe next year, not only we need to do a class, I think we need to do a seminar or like a class where we can teach, these specific things and like have stuff to give to the audience for them to know what to follow. But also we need to do another podcast because I have like 1,000 more questions that I wanted to ask you, but I know that your time is valuable and I don't want to take all of your time. So what I want our audience to know is like, did you want to leave our audience with a little bit of last thought or something, an advice that you want to give them now that we're in December and going to January, and each of you can give us your perspective, a little advice.
Definitely. Well, I have actually, maybe I could think of 2 real quick, right? One of them is educate yourself a little bit more on what is in your tax return. This is what we also get every year. Sometimes you trust so much your accountant and you're just like, I don't know, I'll just give them all the information. Well, you're not doing your due diligence for yourself because you give us the documents, we will do the work, the accounting, but you need to be educated on what it is that you're doing in that tax return. Why am I paying that tax liability? Why am I getting this credit? And this is, I believe, and I make sure I am different from every other tax preparer if they're not doing this. When I do a tax return or bookkeeping, I make sure I explain and I require for my client to meet with me through Zoom for me to explain to them why are you paying this money, or why are you getting this credit, or why are you getting this refund. So my biggest advice is make sure you educate yourself to make sure you understand your tax return, because it is your money. At the end of the year, it is your money. You want to know where it's going. Now, for the end of the year, start gathering all your documents. This is a very common thing that they do. They waited until actually tax due date and trying to get all these tax documents. And we get this is a common thing as well. We don't mind, but understand we're here to help you, but I understand that this is going to cost you more money. So if you come to me on a week or 2 weeks before tax season is due, and you want me to do your tax return and you don't have all the documents, one, automatically I'm going to put you on extension because I need to do your tax return the right way. Or if you do have all the tax documents, there is actually an additional fee to be able to help you, because now we have to go spend a lot of time to try to get this done before the due date. So my biggest advice is educate yourself, know what really is in your tax return, what everything means, and as well, prepare yourself before the end of the year. That way you will save yourself some money, some peace of mind, and you at least you understand what it is. And makes things a little easier for you and me. Now, don't get me wrong, if you don't have anything ready, I'm still here to help you. And I know, Allyssia, we help. We like messes. We're not afraid of a mess. Because I have a client that normally comes like, I'm sorry I'm bringing you all my mess. I love your messes. I clean it up. I'm happy with that.
Regina, you know what? This is good because I believe I'm going to do a challenge that you need that in our class. That guys, put a comment in the message below and tell me if you want a class like this before or in January, where Regina is going to tell us everything step by step of what it is that you need to do your homework with. Because you can tell us to do our homework, but if we don't know what the details of the homework entails, there's no homework to be done. I'm telling you that right now.
Right.
But thank you so much. What do you have to tell us, Allyssia?
I laughed at Regina. She said, make sure you understand what you're reading. And you're signing your tax return ultimately at the end of the day. This is, I as military, people who join the military, a lot of times we signed on that dot and we did not read that long form. We just signed our souls away, just like, go, we joined it. And that we have to start undoing that mentality of I'm just doing it because I only know a part. And you want to know what you're getting yourself into, and you want to know that you're able to reap the benefits of all the hard work that you've been doing. But that being said, just to kind of build off of Regina said, what I always try to communicate to every one of my clients is your accountant, your tax preparer is a partner. We are not, you have, when you start thinking of it that way, when you start looking for somebody for that manner, you're going to start reframing your mindset on what needs to be done and what needs to be discussed. And I always say, talking about money is an intimate affair. I mean, people are scared to talk about money. It is something that I think in our community that is like, you don't talk about how much money you make.
Taboo.
It's very taboo. And unfortunately, we have to undo that by saying, we're not here to broadcast your finances. We're here to help you grow. And the only way we can help you grow is by speaking up and opening up to us and telling us, what are your struggles? What are you looking to change? What is not sitting right with you? What needs to be done? Because sometimes it will lead into a direction that, you could be pushing in all your business. And if you don't understand what the numbers mean, then it can't help you. You're kind of just keeping yourself stuck. So just keep that in mind, that start looking for somebody who isn't just going to be a robot. We are not here to be TurboTax where you just stick some numbers in us and we generate a paper. We are here to help you grow. We are here to talk about your business. We are here to educate you because helping you helps us. We want to see that growth, and understanding your tax return is really, ask questions. We We are not children anymore. We are business owners. Ask those questions. Don't be scared, because at the end of the day, this is your money. You know, anything I put down on this paper doesn't matter. It's you. You know, these are your numbers. You created this. So you need to start saying, what does this mean? Like, what is all my hard work is saying about where I'm at? So just keeping that in mind every year as you're going in, you know, don't think of it as a robot. You know, we're here to grow together. And that's really what you have to focus on.
Right.
Thank you so much, guys. You guys have dropped some bombs. I love it. So the last thing that I like to ask you is, where can audience, our viewers, our listeners find you? And could you let them know in which states? Are you in all 50 states? How could you help them, and how can they find you so that you can help them?
So I'm actually everywhere. I have a website. My website is rgtaxcbs.com. I am in Facebook, I'm in Instagram, and my company's name is RG Tax Consultant and Bookkeeping Services. I actually service the 50 states because we are virtual tax preparers and bookkeepers. After the pandemic, the pandemic brought in a lot of bad stuff, but one thing that it brought in as a good, it opened up the community and the society to work as virtual. And this worked out amazingly because you don't have to go into a tax accountant and sit there for hours until things get done. We work virtually. We have client portals. We are certified by the IRS. I am a AFSP certified. So we have the client portals where you go upload your documents and be secure. And we talk to you through Zoom in your own convenience time, right? So if you can come in during the week, but you want to meet with us on Saturday morning, we accommodate you and we meet through Zoom on Saturday, and you come for of your own home. And then you don't have to bring all these papers. You could just upload them later on or whatever needs to be done. So that's how we work. I work as a virtual tax consultant and bookkeeping, especially for the military. I have I get to service military soldiers that they are in Germany, that they are in Hawaii, that are in Alaska, they are in Puerto Rico, they are overseas. I still get to serve them. As long as you have internet and emails, we get to help you.
Oh my God, this is so good. Thank you so much, guys. Listen, do not take this for granted. You don't believe that anybody can just do your taxes. Make sure you go to the experts. Make sure you go to the specialists, because yeah, a lot of people could do taxes. Yeah, like she mentioned, you could do two-word taxes. But for the military in particular, we have so many intricacies that we ourselves don't know. But the experts in our field, within our little niche, can help you tremendously. Do not take them for granted. So please go to their websites, go to their social medias and reach out to them, especially now, so that you can start doing your homework. And please, please, please look out for the upcoming class, because they're going to give us a class. And please let us know if this is the class that you would like to, so that you can start getting prepared and doing your homework, so that when it comes January 15 or April 15, you are ready to go and you can get them to work for you. Guys, thank you so much for tuning in on our Doral Homes Real Estate Talks, and on today, this episode 8. Thank you, Regina. Thank you, Allyssia, for coming on. I can't wait to see you back here with us again. Have a great time, guys. If I don't see you next week, have a happy holidays and see you next year. Talk to you soon. Bye, guys.